Welcome to the Money Rules Podcast, where we tackle your personal financial matters with leading financial advisors. Your host, Boitumelo Ntsoko.
A living trust can be a powerful tool for achieving specific estate planning goals, but there's a lot to understand about how they work and whether they're the right fit for you. To help us navigate this, we have Gareth Collier, who is a certified financial planner at Crew Invest. Welcome, Gareth.
Hi, Tumi. Thanks for having me.
Gareth, for some of our listeners who may be unsure, could you please explain what we refer to when we talk of a living trust?
So a living trust, sometimes also called a discretionary trust, is set up during the lifetime of the founder or the founders. Generally, this is done for specific estate planning goals. And what will happen is that the founder will set up the trust with the trustees. Once the document is set up and the trust deed is in place, then the founder can then start moving assets into the trust. This can be done one in two ways. Either the founder can donate assets into the trust. Now you've got to be careful that you could be subject to donations tax each year. The other way that's typically done is those assets are sold to the trust, and if the trust doesn't have any cash in it to begin with, it's usually done on a loan account, and then typically those assets will be donated on paper over a period of time until that loan account is settled. Once the assets are in the trust, then people need to remember that the trustees then become the custodians of those assets. So you've got to be careful that you treat those assets as arm's length if you are a founder and a trustee. And then ultimately the named beneficiaries of the trust will be entitled to receive the benefit of those assets, be that income or maybe some distributions, depending on the nature of the assets held in the trust.
And what are some of the goals that one could achieve by setting up this kind of trust?
So I think we've briefly touched on it there, but typically the main intention is to make sure that assets that you've accumulated are protected and used for the benefit of the beneficiaries of those trusts. So those could be the initial founders themselves, as well as their children and sort of family to come from there. Typically, you would consider this when you want to go through, what's colloquially called like an estate pegging technique. So that's where, let's say for argument's sake, you've established a business that looks like it's heading in really, really good direction, and it's going to accumulate a lot of value over time. People may consider moving such assets or properties and things into these trust structures so that any additional growth of those assets then happens inside the trust from that point and not inside their personal estate, which makes it very efficient for succession planning, because once the trust is established and the assets are inside them, then the trust obviously doesn't have a lifetime. That can carry on in perpetuity. The other main reason people would consider setting up a trust is that if beneficiaries that they may have, and typically this would be things like disabled financial dependents, be that children or maybe other family members who the founder is possibly financially responsible for, should they pass away, those beneficiaries will probably not have the capacity to look after those assets themselves for their benefit, and thus using a trust can be very, very useful because you can transfer that sort of responsibility to trustees to look after those assets for the benefit of those disabled beneficiaries.
Gareth, there's a lot of information around about how setting up a trust can help you save on tax. Is this true in practice?
Yes, but I think we give a heck of a lot of focus on the estate planning reasons for the tax efficiency. So people will tend to focus on minimizing their estate duty that they could pay in their personal capacity, but then maybe don't think of the secondary consequence, which is to look at, well, how are those assets then taxed within the trust itself? So trusts are liable to be taxed at a flat rate of 45%, unless of course that is the trust is set up for a disabled person, in which case it's treated as what they call a special trust, and that is then taxed on a sliding scale between 18 and 45%, effectively, as you are in your personal capacity on the PAYE tables. Obviously, the main benefit then is that once those assets are in a trust, you're no longer liable for additional estate duty or executive fees, all the other kind of costs that are typically associated with winding up an estate.
Earlier on, you mentioned that this kind of trust can be used for succession planning, which I think would be an attraction for a number of people. Can you just tell us more about that?
Yeah, so, let's take if you buy a family holiday home, right? You may consider keeping that in a trust because, you want not just your family and sort of the next generation, but future generations from there to benefit from it. So as I mentioned earlier, you may be the individual, maybe you and your spouse were the ones that initially bought it. But once you pass away, you've got to kind of pass it down and down through multiple generations, which may kind of disperse the ownership of that property. Whereas if you establish a trust, obviously the trust entity then houses and owns the property, and the beneficiaries will just change over the years, but it doesn't incur sort of any estate-related expenses or taxes. The other part, like I mentioned, is if you've got the likes of a business that may become well established and you would like your family and future generations to benefit from that, or of course if you've got other financial assets that can be held in a trust, such as your typical unit trust accounts, or even nowadays the likes of your living annuity could possibly go into a trust if you pass away, and that can be used to disperse the benefits across all those beneficiaries.
You also mentioned special trusts. Can you tell us what makes them special?
So a special trust, so that's defined under what they call Section 6B1 in the Income Tax Act, and that is where somebody qualifies as a disabled person, and that definition there means that they are, for any reason, typically mentally incapable of managing their own financial affairs. Then that trust, if it's set up for that specific need, can be considered a special trust, and then it gets the advantage of being taxed effectively as an individual rather than a discretionary trust.
Gareth, are there any barriers to forming a trust, and can you tell us what they are?
So in terms of setting up a trust, it's quite sort of an administratively intense process. There's obviously lawyers that are involved and accountants that are involved. You've got to make sure that trust documents and deeds are drafted correctly, in line with the legislation. They meet all the requirements. They've got to be registered with the Master's Office. So there are a few sort of legal boxes that need to be ticked. And then once the trust is in place, then it needs to be handled almost like a business. So annual financial statements need to be completed, income tax returns need to be completed, and when it comes to the trustees are meant to have sort of annual meetings. We need to keep a record of all those resolutions that are taken care of in those meetings, and then you need to sort of maintain an asset register of the trust as well. So there are a few elements that need to be attended to each year, and that obviously incurs additional costs to the trust as well. They, of course, shouldn't be considered necessarily a reason not to do it, but we just need to be aware of those.
And what are the costs involved in setting up this kind of trust?
So part of it, like we've mentioned earlier, like let's say you've got a business that you would like to house in the trust. One of the challenges there can be that, once assets are placed in a trust, they're meant to be handled at arm's length from the founder. If that's seen to not be the case, then sort of the term that's used as the trust is seen to be as a sham, and then that veil in terms of where the trust sits can be pierced, and those could be considered part of your estate if you pass away. Bearing in mind, when it comes to estate planning, we do have the abatement in place. So the first 3.5 million rand of any individual's personal estate is not liable for estate duty to begin with. So unless your assets or your total estate is above that, you're not going to necessarily benefit from setting up a trust unless you have very specific goals, such as a special needs child or something like that it would make sense to do it for, regardless of the size of your estate.
Gareth, as we wrap up, are there any closing remarks you'd like to share with our listeners?
Yeah, I think we've kind of covered some of the salient points when it comes to considering a trust. So if you are considering setting up a trust, I would strongly advise that you get together with your planner to talk through the reasons why you would want to set up that trust, what you're trying to achieve. They should then be in a position to advise you as to the pros and the cons, and kind of maybe discuss all of those. And if it does make sense to go through with it, typically your professional practices will probably have either in-house or externally relationships with other lawyers and accountants that can help you get things established in the correct manner.
Thank you, Gareth, for joining us in this episode and sharing these valuable insights.
No, only a pleasure. Always lovely to be here.
That was Gareth Collier, who is a certified financial planner at Crew Invest.
Thanks for listening to this episode of the Money Rules Podcast. To listen to more, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates. Money Rules. Moneyweb, your trusted source for business and investment insights.